All right, good morning, everybody. We'll get started here in just a second. So let any folks that are planning on joining the meeting. So sit back and listen to some of this gentle music before we get started in just a few minutes. All right, let's make sure that everybody get myself going here. All right, good morning. I'm gonna make sure that I've got all the technical stuff going here properly. Hopefully you can see the presentation, and we'll dive into that here in just a second. So hopefully everybody can see and hear me okay. So all right, now that it is the top of the hour, we will jump right into it and get going. And anybody that joins late, they're just gonna have to catch up. So all right, welcome to our monthly market update meeting, and thank you for joining me. This webinar series continues our monthly sessions where we discuss what's happening in the global and domestic economy and markets, and provides you an opportunity to ask questions, have a discussion, and talk about what you are hearing and seeing out there that may impact your personal financial situation. In the email that was sent to you, you should have received the market update quick hits summary. That's a document that summarizes the key points for the month. We will go through those in just a moment. Also in that invitation, you should have received the link to the video blog post by Chris Fasciano, that is Commonwealth's Chief Market Strategist. He provides a good summary of what we're going to discuss as well. So I conduct these webinars. I'm sorry, I got myself a little bit lost. So in addition to these webinars, Chris's videos provides a quick summary of the various factors that we're going to talk about. I also want to highlight that much of the information that I'm going to discuss today is also available on our website. If you go to our website, which is www.leslieroperday.com, and you click on the market updates tab, it will show you both the video as well as the documents that are being sent to you by email. So that's another good resource if you miss it. Or also if you want to go back and look at anything in the past as well. All right, let's get started. I'm going to summarize the market update for you and discuss any factors that I think are worth mentioning, and then I will open it up to any questions if there are any. So, all right, so the markets rallied to start the year for January, with international stocks outperforming U.S. companies. Rising long-term interest rates weighed on bond markets, although that was slightly. Investment grade and high yield bonds were still able to post modest gains for the month. And looking forward, continued economic growth and market appreciation remains the most likely path forward in 2026. So beyond the headlines, we had a solid start to the year for the markets. Again, long-term yields rose a little bit, and the Fed remains sidelined. We'll talk about that a little bit more. We have economic report updates with job market headwinds, and looking ahead is cautious optimism despite some ongoing risks. So just to summarize, as I summarize this slide here, January was a little bit of a mixed month. We did have some volatility, but the month ended mainly on a positive note, with all of the U.S. market indices up positively in low single digits. Additionally, international markets were up even more, with developed international up almost 5%, and surprisingly, emerging markets up almost 9%. So it was a good start to 2026, mainly supported by continuing solid fundamentals. So we'll just do a quick look at the market performance for the month. So the Dow Jones ticked up by about 4. The Dow Jones Industrial Average ticked up by about 4.7%. The S&P was up 2.7. A big amount of the gap there between the Dow Jones Industrial and the S&P has a lot to do with the tech stocks. The Magnificent Seven had a pretty good January. And the Nasdaq was actually the laggard in the month at 1.64%. And then next down, you can see the MSCI, that's the International Index, had a return of 4%. And then the Bloomberg U.S. Aggregate that's the bond index, was up just about 0.5%. So pretty good month, even though you can kind of see the big dip in the middle there, right towards the middle of the month there. If we just look at the prior 12 months, just because I only have 1 month's worth of data for 2026 so far. So as we move forward, the year-to-date performance will start to be rolled out. So, but if we just look back at the last 12 months, the Dow Jones was up almost 10%. The S&P was up almost 15%. The Nasdaq was up almost 20%. And the international indices was up a staggering 35% over the last 12 months. So, and bonds, again, have done well, up just under 7% for the last 12 months. So pretty much, all the way around, we've had a pretty good run for the last year or so. So we'll take it. We won't complain. Now, is that going to continue? Well, let's kind of talk about that. So the market indices have been continuing to grow. We had a little bit of a pullback in February. I'll talk a little bit more about that next month. But market indices have continued to grow primarily because of solid market fundamentals. We are in the middle of fourth quarter earnings reports right now, and by and large, most companies are still beating their expectations, with the average earnings reported at about 12%, which is well above the 8% expectations that we had coming into the year. So solid earnings reports. It appears that Americans, despite their continued concerns about inflation and the overall economy, are continuing to spend, and that spending continues to drive the economy, company profits, and the markets. So there you go. That's companies are still making money because consumers are still spending, even though they don't feel very positive right now. Additionally, the bond market has been up for the month. It did see a little bit of pressure with the 10-year yields rising a bit. So if you're not familiar with that dynamic, as yields rise, bonds tend to fall. We kind of had the opposite effect. We have a slight rise, but high yield and high yield bonds, and I think bank notes, as well as intermediate term bonds have continued to be supportive. Short-term interest rates continue to remain flat, with the expectation that the Federal Reserve would keep rates the same, which they did when they met recently. The markets are expecting a 2 to 3 rate cuts by the Fed throughout 2026, driven by what appears to be a slowing job market. The current Fed rate sits at about 3.5%. which would put, if those expectations about rate cuts hold true, that would put the Fed rate somewhere at 2.75 to 3% by the end of 2026. I'm somewhat skeptical about this expectation. We will see with what is expected to be a new Fed chairman. Currently, the president has nominated Kevin Warsh to be the new Fed chairman to replace Jerome Powell. That we're waiting to see if that actually materializes or comes true. Has to get through Senate confirmation, but if he's ultimately confirmed, we will see what happens. He has been more in line with the president's prerogative to cut rates, but it is a 12-person board, so depending upon what happens with the economy and the job situation will dictate whether or not that those rate cuts actually materialize or not. So I would expect that we could see one or two. I think three might be on the long end of that. So we'll keep our eyes watched on it. All right. One other caveat that is related to interest rates that people often talk about is how it affects mortgage rates. What is happening right now is the yield curve is steepening, which means that short-term rates are coming down, whereas longer-term rates are rising. So as longer-term rates rise, that puts upward pressure on mortgage rates. So I don't expect significant declines in mortgage rates. They could come down nominally, and we could see them between 5.5% to 6% by the end of the year. But would not expect them to come down materially lower than that outside of some significant economic problems. So right now, that does not look like it's the situation, although sometimes things change quickly. So I do expect mortgage rates to kind of maintain their status quo for the time being. The direction of overall employment still seems to be one of the biggest watchouts right now. The December jobs report came in showing only 50,000 jobs were created in December, with significant revisions down for previous months. So we're definitely seeing a slowdown in job creation. Is that going to lead to a slowdown in the economy? It's unknown right now. We're not sure whether or not we're seeing the AI effect starting to chip into some of those jobs or not. We will have to keep our eye out on the GDP, the gross domestic product, and the overall economy to see whether the slower job creation actually translates into slower economic output. So jobs being the one factor, consumer confidence is also another thing that we are watching. Last month, consumer confidence hit the lowest level in 12 years since 2014, which is surprising. So the economy seems to be doing well. The markets are up. Consumers are spending, but they feel terrible about how things are going. It's a real interesting time right now. So, however, if consumers continue to lose confidence, that means they generally slow their spending. That leads to lower economic activity. That leads to lower company profits, and that leads to softening markets. So we'll have to see whether or not the consumer confidence continues to play out in terms of real effects to the economy and the markets. Of course, there are other risks to watch, particularly foreign risks. We are still monitoring the after effects of the capture of the Venezuelan president. Those after effects do seem to now be somewhat muted. That kind of confirms my previous assumptions. While that it was a big news story, it does not seem to be having a huge amount of economic impact, at least not so far. We're continuing to see tensions in the Middle East, particularly with Iran. And the headline international issue coming into the year about U.S. taking over Greenland seems to have waned, although some of the underlying international tension does not seem to have fully dissipated. So, additionally, the ongoing tensions around U.S. immigration policy have continued to dominate the headlines, although the start of the Winter Games may have sidelined some of that, at least temporarily. So, so despite these risks, the U.S. And the world more broadly seems to be in a decent place economically, despite the fact that the Dow recently crossed the 50,000 point mark. Markets continue to signal growth, and that's a pretty good spot to be in as we look forward to some spring flowers. So it does not look like we have anybody actively on the call today, so I'm not going to open it up to any other questions. I'm just going to leave it there for the time being. However, if you are watching this after the fact and you do have some questions, feel free to call me and we can talk about some of the implications for any of the things that we've discussed here today. Okay, our next monthly market update will be Wednesday, March 11th at 11 a.m., assuming that the information has been published by then, so please keep your eyes open for the next invitation. If you have any friends or family that you think would enjoy participating, please feel free to forward them the invitation as well. We also have other scheduled webinars on various financial planning related topics. The next one will be on Wednesday, February 25th at 12 p.m. I will be speaking about how to evaluate various investments and discussing various key metrics to consider when evaluating your investment options. So I hope you can join us for that. In March, I will be presenting on Roth conversion strategies. So maybe you might be interested in one of those two topics. You are always welcome to find my previous videos on various financial planning topics on our website under the events section, under past events, and by clicking the watch the recorded link video. Watch the recorded video link, excuse me. And as always, if there is a topic that interests you, please shoot me an email and we'll see if we can get that scheduled. So that's all I have for the time being. So I wish you a wonderful February, and we will see you again next month on the 11th for our next monthly market update. All right, take care, everybody. Thank you.